Boom. We are live, ladies and gentlemen. We are excited to have one of our favorite returning guests here, Tyler JENKS, coming back onto the show. Tyler, how are you doing this morning?
I'm doing great, Tio. How are you?
It's a beautiful day in the jungle, so I can't complain. I've been seeing New York has negative temperatures, and I'm glad I'm not in the Northwest or the Northeast at the moment, for that matter.
Yeah, my daughter just moved about a month ago to Michigan, and they just had -40 below zero and 2.5 feet of snow.
Yeah, far too much for me to handle. So, yeah, the last time we spoke, we mentioned that we were going to take a look at some of the hyperwave specifics, and I think you mentioned that we would do.
There we go.
Hello, are we back on? I think I had a little bit of an internet glitch there for a second.
Yeah, I think it froze up for a second, but looks good now.
Okay, I'm not sure where I got cut off there. Maybe you just want to you want to fill us fill us into what you were thinking, just in case I get cut off.
Sure, absolutely. We had a great discussion last time where I just laid out the basic properties of this funny thing called a hyperwave. And since then, uh, we've seen the price of Bitcoin hold right around the $3,200 to $3,400 level for a very long time. Tried a couple of times to get up to 4,000. I've been saying all along that I'm a little disinterested right now in Bitcoin prices because, to me, they're going to keep drifting lower and lower until they finally hit my final target of 1,000. But I wanted to make clear to everyone that that is not a terminal number for me. So Leah and I wrote an article in Medium called The Long and Winding Road to $10 Million Bitcoin. And that's really where I believe it needs to go. I believe there's a chance that it's going to get there. And I believe, more importantly, that that will help alleviate the world debt problem. But if anybody has not looked that up, you can go to Medium and just look for Lucid Investment Strategies or Tyler JENKS or Leah Wald. And again, it's called The Long and Winding Road to $10 Million Bitcoin. So yes, I am bearish. I have been for over a year on the whole crypto space, including Bitcoin, and we had a great discussion about that in our last meeting together. So I've been looking forward to this one so we can talk about the positive side and get people to understand that with me, it's don't tell me what to buy, tell me when to buy it. So the tools that I use, don't try to draw conclusions based on what I want to believe or what the fundamentals tell me are true about something. It's very difficult for us in the analytic world to put fundamentals together with timing. And one of the reasons I became a technical analyst is I saw how difficult it was to do just fundamental work, get all these numbers and opinions and strategies together, but then not have it work out in a timely fashion. And by overlaying technical analysis on top of that, you can be much more precise. And so that's kind of where we left off last time, and we can go anywhere you want to go today.
Nice. So I mean, there's a lot of naysayers that don't necessarily understand the depth of why technical analysis works. You and I kind of dove into it deeply about some of the Fibonacci, the fee relationship, and basically the charting of the emotions. What we didn't get to go into last time was what the hyperwave looked like, because you didn't have any of the charts ready to bring up. Is there a few, like uranium, that you wanted to go over now, just so we had a clearer picture of what the full extension of the hyperwave looked like and give us a reference point?
Right. What I'll do is I'll go to screen share, and I'm going to pull up the largest hyperwave that I have been able to find. that doesn't mean it's the largest ever. It's simply after 40 years of researching, this is the one that is key to a lot of our discussions today. And what you're looking at here is a hyperwave of the yield on the 30-year T-bond. And let me just go over the basics. We talked about them. But first of all, you get a long period where prices stay flat. In this case, it's almost 8 years back in the early 1940s. And then you break out to the upside along a line that is described by the bottoms. And this angle is usually around 45 degrees. That's phase two. Phase one is the flat phase. Phase two, it begins up. Phase three accelerates up very quickly. And then phase four goes vertical. Now, a lot of people know those as a bubble. And as we talked about in our previous show, all hyperwaves are bubbles, but all bubbles are not hyperwaves. The difference between the two is that hyperwaves are always linear. All of the lines describing support and resistance you can draw with a straight line. And because of that, I never use semi-log charts or log charts, just arithmetic charts. If you change the chart to either semi or full log, what it does is it bends the lines, and it is not as precise at all as using this linear concept. So after you go through a 1, a 2, a 3, and a 4, never a 5, you get a break, which is phase 5. You then go up again, which is a phase 6. And then for a long, long period of time, you go all the way back down to the bottom of the hyperwave. And we can talk more about this chart because it's so important. But what I also wanted to do is pull up another chart, which is the one that we looked at briefly last time, which is a Bitcoin chart. So to do that, what I'm going to do is I'm going to do another quick screen share in which we will pull up the current Bitcoin chart. And I will show you, if you keep in mind what we just saw, I will show you why hyperwave is such an important concept. Here we have Bitcoin, and I'm going to roll it back a little bit further because you'll notice the chart looks very similar to what we just looked at with credit, with the 30-year bond yield. We had a long period of flat phase 1. We then moved up at an angle of about 45%, which is phase 2. Then we accelerated into a phase 3, straight up into a phase 4. We broke into a phase 5, up to a phase 6, and we've been going down ever since. And that's why I say that Bitcoin is going to 1,000, not because I'm picking that number out because it's a round number or anything else. It's just that that's where the phase 1 started this whole thing off. Now, we found 450 different hyperwaves that all look exactly like this. It doesn't matter if we look at the Japanese stock market or we look at the Dow Jones Industrials in the 1920s and 30s, or we look at the dot-com bubble in 1995 to 2000. They all look exactly like this. You can take the name Bitcoin off, or the name US Treasury market, or the name Japanese Nikkei. None of that matters. What matters is that this thing called a hyperwave is a type of a bubble that instead of simply being an explosive move on human behavior and human reactions, from doubt and fear up to huge enthusiasm and then overconfidence, and then all the way back down through a period of time where fewer and fewer people become confident and more people become frightened, and finally despair, and then capitulation, which Jesse Livermore back in the 1920s identified as something he had seen many times. And now we've got all kinds of behavioral charts that look the same. What's important to understand, though, is they are not the same, because very few bubbles ever become hyperwaves. And because of that, unfortunately, hyperwaves have not been identified until I accidentally fell into it back in 1978, 79, and 80, and began recognizing that some of these things all look the same. And then I started categorizing them, and then I started using them for my clients, big institutional clients where I was managing their pension money. And so throughout that process, I'm going to go back out. Throughout that process, I began seeing the difference between a bubble like Beanie Babies, or like pet rocks, or like so many things that we've seen in history, the tulip bulb mania, the South Sea bubble. There have been the same things with sugar prices in the United States, and even potatoes at various times because of weather-related things. But in each of those cases, you actually do get a parabolic move, not linear. And off of that parabolic move, everyone knows that at some point it's going to run out of gas and come back down. But what you don't know is when, how, and why. Whereas with hyperwaves, we just taught a class, an 8-hour class, teaching people to find hyperwaves and identifying hyperwaves, and being able to understand as you go from one phase to another what to expect, and then when to get out. Because the rules of hyperwave are very specific. When phase 4 breaks to the downside on a weekly closing basis, that hyperwave is over. It's not going to go any higher. In the 400 and some odd examples we've found, there's never been a case, not one, in which when the phase 4 vertical trend line is broken on a weekly basis, that you don't go all the way back down to the beginning. But what's even more interesting to us meaning we have 50 people that are researching hyperwaves in a group called the Hyperwave Research Group, that have been looking all over the world, and we found about 140, 150 active hyperwaves today in various places around the world. And we presented those in our workshop, about 25 of them, just so people could see, take the name off of it, just look at the pattern. It's always 7 phases. It's always a 1 that constrains price, and then 2, 3, and 4 in which price always stays above those lines, never once crossing below on a weekly basis those trend lines. And then 3 more phases in the down phase, a sharp crash like we saw off of 20,000 down to 11,000 on Bitcoin, a big move back up, which is phase 6. In this case, in Bitcoin, it took us to 17,500. And then the long phase 7 that gets you back down to the beginning. Now, a number of important observations. Number 1, almost none of those hyperwaves disappeared after they were over. In other words, the underlying asset didn't go to zero. Many of them actually started other hyperwaves, sometimes 20 years later, sometimes 30 years later, and sometimes immediately after the first one, which is what I'm hoping and believe we're going to see with Bitcoin. But the second most important thing about these hyperwaves is when phase 4 breaks and you drop sharply into phase 5 in the crash, it doesn't last very long. It's very brutal, but it doesn't convince anyone that the initial move is up. And what's wonderful knowing Hyperwave and what happens is you now expect a counter trend move called a phase 6. And here's the point. Not a single one in a phase 6 over the 400 plus that we've studied ever goes higher than the original phase 4. It always peters out at a lower price, which gives you as an investor the ability, if you didn't get out on the crash, to ride it back up, knowing it's not going to keep going higher than the original phase 4. And now you can step aside because now you've got years of phase 7. We've only had 1 year in Bitcoin so far. We've had the first anniversary of the bear market. Unfortunately, I think we might have a second anniversary. I hope not, but that is a possibility. So that gives, I think, people a much firmer view of what these things are and why I got so interested in Bitcoin when someone pointed out to me in April of 2017, Bitcoin looks like it's starting a hyperwave. And that's when I jumped in with both feet to really understand what was going on.
Nice. Yeah, that definitely helps with the clearer picture, charting it out there. One of the questions that I've seen in the chat here are people are asking about the earlier Bitcoin days between years of 2008 and 2015. Was that considered a hyperwave, the run up to $1,000 then as well?
No, it wasn't. The most important part of a hyperwave is the phase 1 line. And if you just kind of mentally picture what's happening, phase 1 lines are always horizontal. They don't have any angle, even 2% up or down. They're horizontal lines. The one on Hyperwave was right around the $1,000 level, even though on some exchanges we got up as high as 1,300. Others, we just barely got back to 1,000. And there's only a couple of touch points. But back in 2011, 2012, and again in 2014, 2015, where we had these bubbles, where we had tremendous price appreciation, what's important is that all bubbles have a tremendous price appreciation, but only hyperwaves follow these particular rules. And therefore, it's easy to try to put every bubble into a hyperwave, but you'll find yourself getting very frustrated. You need this long period of time. In this case, it was almost 7 years of an inability to get above a certain overhead resistance. And let's just call it 1,000. And what happens is every time you run up to 1,000 or 800 or 600, you get turned back down. And that's what those first two little bubbles were. They were giving you an idea that this thing is very powerful, that the emotions run very high, but the asset didn't have the internal workings to keep that going. So it took years to develop and years for people to debate it. And finally, when it broke out above 1,000 and held it early in 2017, starting in late 2016, early in 2017, it began that move up, that 45-degree angle. And to me, that is still not a hyperwave. Only about 1 out of 5. If you go back into chart books, I have chart books going back to the early 1900s of hundreds and hundreds and hundreds of securities. There's one published by a group up in Boston called SRC, Securities Research Corporation. That's a 35-year chart book. And so if you've got one from 30 years ago, which I do, that would go 35 years back from 30 years ago. And then every 5 years, I'll get a new one. And so you can flip through these hundreds of charts just looking at what this phase one looks like. Almost all companies, almost all assets go through long periods of time of indecision, which means price comes up to a level and then sellers come in and sell it back down. Up to that level, sell it back down, over and over again. I've seen some phase one lines that last as long as 14 years. From 1908 to 1922, the Dow Jones Industrial Average couldn't get above 100. That was the highest it had ever been. And so for 14 years, it kept getting up there. Now, that includes the establishment of the Federal Reserve, the panics of 1907, 1909, World War I, all of that historically was going on, and the Dow Jones Industrial Average couldn't get above 100. Then in 1922, it broke above 100 and started a real hyperwave. Phase two, phase three, phase four, it went from $40 to $388, about 10x, and then peaked, and then went through the next three down legs that took it all the way back down to 44 bucks in 1933 and early 1934. So it took 14 years of building up all that buy-sell pressure. Once it was relieved, you went into a hyperwave and came all the way back down to the beginning. And then it took all the way till 1954, from 1929 to 1954, before we got back up to those highs again. And that's often what you see. I showed the credit, the US 30-year Treasury bond 80-year hyperwave that just ended 4 years ago. Now, you and I talked about this before. Hyperwaves occur very, very rarely. Now, when I say we found 400 of them, you've got to understand what that means. There's something on the order of 75,000 corporations around the world that are publicly traded. There are hundreds of commodities. There are thousands, 20,000 plus mutual funds, ETFs. Out of all of those, we've only found 400 examples of hyperwaves. And what distinguishes a hyperwave is it appears to only take place when there's some massive macroeconomic shift taking place in the world. So the thing that drew me to Bitcoin as a trading vehicle was not the fact that we can make money, and it's because it's signaling something. It's signaling that something is going on with world macroeconomics that is going to change the world, either for the better or the worse. And that's where hyperwaves show up. With Japan, it signaled for 20 years that Japan was becoming not only the 10th most dominant economy in the world, but then the 5th, then the 3rd, then the 2nd behind the United States. And then by 1989, where the price of the Nikkei had run from less than $1,000 up to 38,800, almost a 40x move. It was because Japan was displacing all these other developed countries around the world as the fastest growing, most dominant economy in the world. Much faster growing than the US. It never quite caught up to us. It came in number 2. Then what happened is it was replaced by China. So not only do we have the big debt credit problem in the world that we talk about in our Medium article, and why I think Bitcoin could someday go to $10 million to solve that problem, but more importantly, that things like China replacing Japan in the number 2 role, things like China, Russia, and India being the biggest buyers of gold for the last 7 years, one of those three, but the three together every year for the last 7 years have been the biggest buyers of gold in the world, tell us that something enormous is going on and must be dealt with. And so it shows up in the form of Bitcoin hyperwaves, stock market hyperwaves, FANG stock hyperwaves. Why did we have the dot-com bubble? Because the internet was changing the face of macroeconomics worldwide. And it showed up in the form of the NASDAQ and certain NASDAQ stocks that were internet related going into hyperwaves, which then crashed and went all the way back down again in 2001, 2, and 3. And just to put a little more icing on the cake, they did it again in 06, 07, 08, 09 before starting this next move up. So a lot of very interesting things about this thing that we call a hyperwave.
So we had mentioned this before. I agree with you. There's a lot of negative sentiments, I think, that are going to help bring us down lower. And as many as people that don't like to hear that, I've felt that's been true since as soon as we broke that $6,000 mark. I was like, oh no, this is not a good space to be in until I find or I feel that there's a bottom personally. So the next part of this story was that hyperwaves happen more than once, that the underlying asset itself, the fundamental value of Bitcoin has not disappeared. What do you, you had mentioned in the article, I don't have it posted in the links, but I will make sure the link for your guys' article is in there below.
Thank you.
Do you want to tell us a little bit, because I've always felt that Bitcoin is going to go a lot higher, that the next moves were somewhere between from $80,000 to $300,000, and then anywhere after that is pretty much any person's guess, because we start to enter one of those macroeconomic shifts where we really can't tell what's going to happen outside of where we are in the next few years. So do you want to tell us how you found the winding road to $10 million Bitcoin after the $1,000 bounce?
Yeah, absolutely. Once again, when I see a hyperwave somewhere in a major index, usually it starts in a major index or a major asset class. Gold and silver did it in the 1970s after Nixon closed the gold window. Those were both hyperwaves, both gold and silver. But we also had hyperwaves in sugar during that same period, in coffee during that same period, during cocoa in that same period, because it looked and smelled like we were going into a hyperinflation. Gold prices went from $35 to $880. Silver prices went from $2.50 up to $48. Those are enormous moves in a short period of time. But they were all hyperwaves, and they ended up breaking and then coming down, and it took gold 25 years to get back anywhere close to where it had been before, which tends to happen with hyperwaves. But when I saw Bitcoin, and you and I talked about this before, I actually started mining Bitcoin back in 2011. But I got very disappointed in not Bitcoin and what it stood for, but by the ability to buy and sell it easily without getting hacked or getting caught on an exchange like Mt. Gox and all the other problems, which I still see today, which I say is the main reason we're having this bear market. We're not having a bear market because anything's wrong with Bitcoin or the idea. We're having a bear market because there's too much confusion in the space caused by the inability of regulators, the media, and the public in general to understand what the heck is going on, what's good, what's bad, what's a scam, what's not a scam. And until that gets cleared up, you're in a bear market. And that's why fundamentally you end up going down in a hyperwave, because people's eyes are opened to the fact that maybe they had too much faith or hope in an idea rather than the practicality of what it takes to get that idea to germinate and be able to grow. You know, small plants, and if anybody knows this, you do, you've got to be so careful when something is just sprouting and just growing. Any one of a million things can come in and crush it. You know, the lack of water, not the right sunlight, right air, right nutrients, whatever it is. Same thing in the real world of assets and asset classes. So when I started thinking about Bitcoin, I was already thinking about the problem of debt and credit in the world. Because remember what happened in 1944 under Bretton Woods. We tried to pull the world out of a depression and a world war that had decimated much of Asia and much of Europe. And the US was about the only thing standing that had any kind of fundamental solidity to it. And so in 1944, the world came together and decided we would go into a gold standard and a US dollar standard as reserve currencies, both of them as reserve currencies to all the other currencies in the world. And that worked from 1944 to 1971. And it kind of constrained a lot of things. It kind of constrained inflation, kind of constrained deficit spending. But whatever it was, when we were forced to close the gold window in 71, now we let all the foxes into the hen houses worldwide. And the foxes in this case were politicians and policies and central banks and the banking system, where if they needed more money, they simply printed more money, which was fiat dollars. And that's been true from 1971 all the way to today. Well, the market punishes that kind of bold diversion from reality by doing things like taking gold prices up to $880, even though the IMF and the US Treasury were selling tons of gold into the market to try to keep the price down. The people said no thank you, and they would buy all of that gold during those auctions. And the next auction, the price was higher. And the next auction, the prices were higher. And finally, the IMF and the US Treasury said, okay, enough is enough. We're not going to sell any more gold. But at the same time, we had inflation. As that chart showed, the credit chart that I showed before, you might have noticed that interest rates went up all the way until 1979, 1980, from 1942. That was the first part of the hyperwave. Then it broke. And from 1979, 1980, all the way till 3 years ago, 40 years up, 40 years down, it came all the way back down to the beginning. Why? Because Paul Volcker, the Fed chairman, crushed inflation by raising interest rates in the United States on US Treasury bonds to 15.5%. And you could get 20% at your local bank in a money market fund. You give them $100,000 and they'll pay you 20% interest overnight on your money. So things were totally out of control. Paul Volcker said, enough is enough. We're going to kill inflation. He pressed interest rates up to the highest levels in US history. And for the next 40 years, we've had a disinflationary, deflationary worldwide economy because of that one action. Okay, that ended several years ago. Why? Because the politicians and the central banks, in order to solve problems like recessions in 2001, 2, and 3, and again in 6, 7, and 8, printed so much money, made so much money available in order to keep interest rates low that the debt began to pile up faster and faster. Bubbles formed, not only in the stock market, but in the real estate market, not only in the US, but around the world. Okay, here we are 10 years later. And what we have is a problem 10 times bigger. In my article in Medium with Leah, we did a lot of research to try to make it clear to people, let's not just throw around big numbers and say, ooh, debt and credit, or ooh, deficit spending. Let's be specific. So what we did is you will find posted there more numbers than you want to read, where I try to break down what actually is the problem, if there is a problem. And is it mathematical? And have we gone beyond the point of no return mathematically? So what we do in the article is we first of all look at the growth of wealth in the world over the last 20 years. Now that's a big number and a difficult one to find, and it took me weeks and weeks of research to try to come up with the best available numbers. And they are in the article, and I would love it for any of your listeners to do their own research and come up with alternative numbers from alternative sources. We need to work on these things together. But in any case, I think the article does justice to the facts. And what the facts are: number one, over the last 20 years, ending at the end of 2018, world wealth, as defined as all assets owned by all governments, all central banks, all sovereign wealth funds, all real estate, all stock prices, all stocks, corporations, ETFs, mutual funds worldwide, plus all pension funds, all savings accounts, all checking accounts, and all currencies around the world put together have grown at 136% over the last 20 years. Wow, that's pretty great. The world has grown by 136% in terms of total world wealth. Now, we're not going to get into how that wealth is distributed and how it's getting more and more distributed to fewer and fewer people and countries. I'm just talking about total numbers. Okay, on the other side of that equation, you've got to look at total world debt. You've got wealth on one side, which must be used at some point to offset the debt on the other side. The good news is the total world wealth comes in about $327 trillion. And total world debt is only approximately $287 trillion. Therefore, total world wealth as of today is greater than total world debt. That's the good news. The bad news is that where total world wealth has grown by 136% over the last 20 years, total world debt has grown by 339% over the same period, which means that even though total world debt has not yet come up to the world wealth, it is a matter of minutes before it does that, because it's growing 3 times faster than total world wealth. And therein lies the problem. The problem for the banking system, central banks, and all counterparties. Now let's think about that for a second. The total value of gold in the world is $7.5 trillion. You go back to a gold standard, and there's only $7.5 trillion available to offset 30 times that amount in terms of debt. Bitcoin at one point with the other cryptos got up a little less than $1 trillion, 1/7 of the amount of gold. Now it's 1/70th the amount of gold, because we've just dropped 70, 80, 90%, depending on which cryptos you look at. Okay. Why is that important? It's important because I use the example of you and me. In our own private lives, the budgets are pretty simple. If you have income that is greater than your expenses for the year, that's called a surplus. And you end up with savings at the end. Yeah. If your income is less than you spent because you took couple of trips too many and, you know, you lost track, then you run a deficit. And you have to pay for that deficit with your wealth in the form of either something in checking or savings, or you have to sell some Bitcoin or sell some gold or sell a piece of real estate in order to make up that deficit. Same thing with credit cards. Okay, so that's the simple model. There's income, there's outflow, and there's what's left in the middle. So if you build up something in the middle by running surpluses, saving money, that becomes your wealth. That's the world wealth of $327 trillion is made up of those things. All the real estate, all the stocks, all the savings, all the currencies, things that we call money, not just fiat money. Fiat's a little tiny piece of that. The biggest things are like real estate. Just think of what all the real estate in the world is worth. All the residential, all the raw land, all the commercial, everything. And add all of those things up, and that's what world wealth is. Just like if you add up everything you've got, and we're not talking about intellectual property, which to me is real wealth, meaning your education, your experience, your viewpoint, your opinions, all of those things to me are the real treasure of wealth. But unfortunately, no one else believes that. So there, nothing is put on it until you convince an employer or an investor that you got some great ideas and they're willing to back you and pay you for your ideas. But other than that, it's a private thing. And so we didn't try to go into that. Intellectual property is a very powerful asset. But unfortunately, for this exercise, we've got to put it apart. Okay. So what all that means is if we take all the money in the world, everybody's, the rich people, the poor people, all the governments, all the corporations, all institutions, all sovereign wealth, you put it all together, we can just barely pay off the debt. That leaves everybody in the world with zero, but there's no more debt. So that's pretty good. But because debt is growing 3 times faster than wealth, before we end this talk today, we might have crossed that point. If not, it'll be next week or next month or within a year or so. It's inevitable. It's mathematical. You've got to either pay down the debt, pay off the interest, or slow its rate of growth down and increase the rate of growth of wealth or GDP around the world. So what I do in the article is I say, let's just all agree that there's a problem. And we now have got some numbers on the problem. And we also know where all the wealth is. So what I do in the article is I say, there's 5 possible solutions to this problem. Number 1 is Bitcoin. Number 2 is going back to a gold standard. Number 3 is defaulting on the debt. Number 4 is growing out of the problem. And number 5 is a mixture of those. And that's what the Chinese have offered in the form of a basket of currencies, including gold, maybe Bitcoin, the yuan, as well as the US dollar in various proportions, all put into a basket that everybody agrees has got value to it. And I would love somebody to give me an idea of a 6th possibility. I have not been able to come up with it. I've made that offer to people, said, please, if I'm missing something, let me know. In any case, what Lee and I decided to do is we're going to write 5 articles. The first one is the one I want to happen, which is Bitcoin. That's the one, that's the winner for a lot of reasons, but in general terms, because it has the least collateral damage to the system, all systems. If it were to be adopted, I don't put high priority on it being adopted. And I try to explain why in the article. The next article, I'm just about finished with it, is going back to a gold standard. Then I'm going to take on the default question, because unfortunately, the default question is probably what is going to happen. And what it means in very simple terms is we will go to bed some Friday night and there will be announcements from the G20 or maybe a bigger body of developed and maybe some growing countries that they have agreed to a new plan. And the new plan is, come Monday morning, when you wake up, all debt will be, there will be a jubilee, which is a biblical term that is forgiveness of debt. But the parties that are forgiving the debt are forgiving their own debt. So the central banks in the various countries that have these enormous debt to GDP ratios will say, come Monday morning, I know, we told you that the $100,000 in US Treasury bonds you have, you will get paid a certain interest rate, and on maturity, you'll get $100,000. But new rules, you're going to get $50,000. And I'm sorry, but that's the best we can do. And everyone will agree to those terms, which also means that it will quickly spread to everything else. Corporations that have bonds, IBM bonds, that you thought you had $10,000 in, you only have $5,000. Just overnight with a stroke of a pen, that is called default. It's only happened a couple of times in world history. Russia defaulted on their sovereign debt, the ruble, for a brief period of time, and the world jumped all over them, and they had to turn around, pay it back, and make good on it. Argentina did it for a longer period of time. But we're not talking about individual countries, not Italy or Turkey or Argentina or Venezuela. We're not talking about individual examples. We're talking worldwide, all at once. Now, the implications of that I'll go into in the article, but as you can imagine, they are enormous. They're both good and bad because there's always a counterparty in a debt credit situation. If you've got a mortgage on a property, that means the bank loaned you money. That means if this goes through and you owe $300,000 on a mortgage, Monday morning you only owe $150,000. If your credit cards have got $50,000 on them, Monday morning they've only got $25,000 on them. Wow, that's great, you say. But then take the other side of the story. What about all of your savings that are in U.S. savings bonds or in bank checking or CD accounts and all of that? Unscrambling that scrambled egg is an impossible task for even supercomputers. Nobody knows what that will look like. What I know or I feel or I intuit is that is not the thing we want to happen, but it's probably the most likely because it's such a difficult thing for one country to make these kind of decisions, for 220 countries to make those decisions at the same time coming out of a meeting bends to incredulity. You know, it's just, so I think either Bitcoin or a gold standard is in the works. What does that mean? Well, here's the way I outline it in the article for Bitcoin. We get to 1,000 or 800 or 700 or 500 on a spike or some number that kills the hyperwave. There is no more hyperwave. There's still Bitcoin. Down at that level, nobody's going to want to touch it. In fact, even Tone Vase says, boy, if we drop down that low to 800 or 700, I'm getting out of the business. I'm not interested. and a lot of people feel that way. They don't want it to go down to those levels because they think that means that the whole experiment has failed. That's absolutely wrong, in my opinion. Bitcoin is going to go much, much higher, regardless of everything I've just said about the world macroeconomics period. But I'm hoping it doesn't go up in another hyperwave. Because if it goes up in another hyperwave, it's going to come back down again. That's what a hyperwave does. And that's not what we want. So I want this to be the recognition on the part of the world, which is not there in any form at this point, that this thing is for real and we can use it and it can take care of problems. So what I do in the article is I outline, first of all, we've got to get back to 6,000, which we will do pretty easily. that will not be much resistance. We'll have a little more resistance at 7,500 and 8,500, a lot of resistance at 10,000, a little more at 13,500 and a little more at 17,500. But after that, we will quickly get above 20,000 just with you and me, your followers, my followers, people that believe in the project will begin buying again instead of sitting back and waiting and getting punished as this thing goes lower and lower, and they're going, oh my gosh, what am I going to do? Now, all of a sudden, that psychology changes, and when you get up close to that old high and break through it, it's granny bar the door, because now there's no overhead resistance, I believe, from 20,000 up to 100,000. I think we get there pretty quickly.
Yeah.
Stop at some round numbers like 50,000, maybe screw around at 75,000, but getting up to 100,000 pretty quick. Now, depending on what's going on in the world, $100,000 Bitcoin at 21 million Bitcoins is $2.1 trillion. What that means is you are now about a third of the way up to challenging gold in terms of its value. And now some other people are beginning to think. So I take a look at all those pockets of wealth we talked about. How much money is in sovereign wealth funds? About $7.5 trillion. How much money is in hedge funds? Well, only about $3.5 trillion. How much money is in mutual funds? $23 trillion just in the United States, and about $37 trillion worldwide. How much money and you go through each of these pockets and then ask yourself the question, who makes the decision to get into something or out of something? And what you will get up around the $100,000 level, I believe, is momentum players that are not restricted in terms of where they can put their money. Now, that means hedge fund managers. That means some mutual fund managers. That means family offices. By the way, I've got numbers on all the family offices in the United States and around the world, how many trillions of dollars are there. Those things are run by individuals that sit and watch asset classes. And when one asset class is like Bitcoin, all of a sudden goes back up to 10,000, 20,000, it will pull more and more of those people in. And it will then get all the people that you've talked to, that I've talked to, that says, no, I don't understand it. It's interested again. And that's why you get a big move. Now, I think that the war over this entire argument is going to come between Bitcoin and gold. A lot of people are saying, well, why can't we do both together? I don't think so. I hope I'm wrong. I might be wrong. But I believe there will be a war taking place with Bitcoin at 100,000 and $7.5 trillion in the gold market. Now, just an aside, people think of the gold market as being controlled by the banks and the central banks. That is not true. All the central banks in the world have only 20% of the world gold. The other 80% is outside the banking system. It's owned by individuals in the form of either jewelry, or there's 7.5 billion of us. And if everybody has a little bit, that's a lot of money, 4 times more than all the central banks have. Which means that gold can, without policy, be a source of supply of wealth into Bitcoin. As people see the gold prices steady or coming down and Bitcoin prices soaring, you will draw money from that asset into Bitcoin. So at $400,000, Bitcoin equals gold. If gold is still around $1,300, if gold is less, then that number will be less. But somewhere between 100,000 and 400,000, a civil war between asset classes will take place, and one of them will prevail. If it is Bitcoin and it takes away from gold, that will then start pulling institutional banking money, sovereign wealth money that is really not run by countries. It's run by a team of people that their job is on the line to be at the right place at the right time for the benefit of their countries. Saudi Arabia and Norway, and there's a bunch of very big ones. The U.S. has almost no sovereign wealth compared to the biggest in the world is China. China has 4 large sovereign wealth funds, and the total of that money is bigger than anyone else in the world, including Saudi Arabia and the Emirates and Norway and all that. But I list all that in the article. But that money will begin to move into Bitcoin, and then it will force central banks to do the same thing. And that's what takes us up to $1 million, and then from $1 million to 10 million if we get adoption. At $10 million, Bitcoin is worth $21 trillion. Excuse me, $210 trillion. $210 trillion is 40% of the value of the world debt. If that value of world debt goes from the current 327 trillion up to 500 trillion, which because of its growth rate, it will be at. So 500 trillion in debt, $200 trillion in Bitcoin, that's a 40% reserve against those counterparties on the wealth side. That typically is the ratio that the gold standard has used over the last 200 years, that fiat money or currencies are backed by approximately 40% of real value, real wealth. Now, if it was gold that wins the battle, and I haven't done all the numbers yet because I'm still writing the article, but if it's gold that wins the battle, and I think you've got to bet on gold. And the reason I say that is because it's a known quantity by central banks. Many central banks own a lot of it. The US owns 3 times more than the next closest. The United States owns more gold than China, India, and Russia combined. And the US is basically in charge of the World Bank and the IMF. And because of that, if we go to a gold standard, thems who has the gold is the winner, and thems who does not is the loser. Just like in the Bitcoin world, if Bitcoin wins, those that have Bitcoin will be the winners, and everybody else will be the losers relative to those that have it. Everybody will be a winner if Bitcoin comes about, but the only way you get to $10 million Bitcoin is if your Bitcoin is bought by a central bank. And you say, and I say, and everybody that read the article said, I'm not going to sell mine. And I say, really? What do you think was a good trade? At 100,000? At 400,000, at 500,000, at 2 million, at 4 million? At what point do you say, once it gets to where it's going, it's not going to go any higher? Yeah, you can have mine. I'll take it, and I will buy real estate, and I'll buy gold, and I'll buy houses, and I'll buy, okay, Lambos. But the point is that who is in a position to always have a bid under the price? And the answer is central banks, the banking system, all the Federal Reserve banks and central banks around the world, because up till the point of time they need to do it, they can print the money to do it. So just as there will be plenty to go around at $10 million per Bitcoin, and you don't want to wait too long, and therefore people say, well, Tyler, you are obviously an idiot, because we're sitting down here at 3,000 and you're saying there's the possibility of it going to 10 million. Why wait for it to go to 1,000 or not go to 1,000? You need to load up on it here. Caveat. That is one potential out of 5 solutions to the problem. I can paint a very dire picture of Bitcoin getting back to 20,000, 30,000, then all of a sudden a gold standard comes out. I'll tell you what Bitcoin will do when that happens. It's going to go back below 1,000, and it'll stay there for generations. Because if the world adopts a gold standard, there's no need for all of this discussion on Bitcoin other than all the other aspects which are fabulous. Unconfiscatability, store of value, lack of transparency, ease of purchase. All of those things are still true, but it no longer can be applied to the world economic picture because the powers that be chose another solution to the problem. All gold standards in the past have failed. This one will fail, but it's not going to fail next week or next month or 5 years from now or 30 years from now. So my caution on how you take your hard-earned wealth that sits in the center of your income and your expenses, you've got to protect that egg. It's not infinitely big. It's very finite. And every time it goes down on paper, it is going down in reality. And therefore, don't tell me what to buy. Tell me when to buy it. Use these technical tools to do that. So that's basically what the story is about.
No, it's wonderful. I mean, there's a lot to unpack in there, and I appreciate you taking the time. One of the first things that jumped out was obviously the negative impacts that something like a monetary control might have if they were to come in and say just release all the debt. That might have a short-term negative sentiment for Bitcoin, but long-term, I feel that what we'll call that a hawkish action by the dove, or by the Fed, excuse me, which is generally quite dovish, might signal to some of those in the fiat system that there are massive problems. Like, for instance, again, when the Cyprus banking run started, these are all positive sentiments for Bitcoin because of its inherent use cases.
Yeah.
So I guess the question that's trying to lead me to, and I hope it doesn't end up sounding too vague here, is I've got a chart I'm going to show really quickly. It's two questions packed into one. One of the first parts of the question was, Tyler, you had said that you're not interested in a second hyperwave, that you would like that it would just to continue to grow and rise. So what I've got up on, I think it's up on the screen here, this is the value of gold marks and paper marks in the Weimar Republic. And as you can see, in 1918, we had one German mark at that time would buy you around 1 gram of gold. And then around 1923, just around 6 years later, you had 5 years later, you had 1 trillion paper marks to 1 gram of gold at that particular time. So what my question is, if we get that particular scenario, at what point do you think Bitcoin, as it becomes a standard, do we start to look at things maybe priced in the value of Satoshis? Does that real price break in upwards momentum come from us now valuing things in Satoshis as in compared with the United States dollar? Does that make sense as a question?
It sure does. It's a great question. And every time we see a hyperinflation, and we haven't seen many of them, it's mainly a theoretical construct, but we've certainly seen some real ones in Zimbabwe and Weimar Republic, briefly in places like Germany, in Argentina, briefly even in Venezuela. And what happens is the currency becomes worth less and less because there's so many of them. They keep printing them to make up for the fact that they're not buying anything, but it's always localized. What we're talking about now, a default is a deflationary prospect because it kills assets. And depending on where you are when that occurs, deflation is great if you're sitting in cash. And the reason it is because the value of things are going down, which makes it look like the value of paper is going up. The reason in the US today, real estate is worth X, which is basically 20 times more than it was at the end of World War II. And the cost of the average car at X is 20 times more expensive than it was at the end of World War II. So people think, wow, look at all this inflation. Everything keeps getting more and more expensive. That's not true. What's happening is the value of the dollar has fallen 95% since World War II in what it can buy. Therefore, it takes 20 times more to buy it than it did back at the end of World War II. So there's two parts to that equation. One is the value of things, and then the value of the paper that is used to buy those things. That's inflation because of printing too much paper. But the flip side of that, deflation, means that the value of things are going down. The value of houses in 2006, 7, 8, 9 fell anywhere from 20 to 50% in the United States and in London and around the world for a brief period of time. And the reason was of this deflationary crush, which is what debt is all about. And the solving of debt by some method, whichever of the five it turns out to be, will have a deflationary effect. But if it was just localized, let's take Italy or Turkey, which have been in the news recently. They've got too much debt. They can't make their payments, either interest or principal, on time. And therefore, the threat is they're going to default on that debt. I'm sorry, we can't pay you. We can't pay you on time. Give us more time. That's the same as a default. People don't like to think of it in those terms. They think the creditor's just being nice. They're not. They just don't want not to get anything back, so they extend the terms. That's usually the first step. But after that first step, then they start renegotiating. Well, I know you owe $1 billion. We'll let you off if you just pay 800 million. And that's a default on 20% of your debt. And that's deflationary when that occurs, because what had value disappears overnight. So how it plays out, if you extended the chart of the Weimar Republic, guess what happens to that chart?
They ended up switching to a new currency, did they not?
Exactly.
Like, new one.
Yeah, but if you attach it onto that, you'll see that the top of the chart comes all the way back down to the beginning, and the Deutsche market is one of the strongest in the world now. So, yeah, you were looking at the front part of a hyperwave before it went the other way, which they all do. And the same thing would be true here, but we're talking on a worldwide basis. And the horror stories you hear about what Weimar Republic looked like for the average person trying to buy bread or trying to get a job or whatever, or even in the United States, our unemployment in 1932, 33, 34, 35 was 25%. One out of every 4 people in the US didn't have a job. And those that did weren't getting paid anything, basically. And a third of all the banks disappeared, and there wasn't insurance on your deposits, which meant all of your money disappeared overnight. Just boom, gone. Bank goes under, that's where your money was. The government doesn't step in and give you any money. That's why it's deflationary when things start going bad. But that's a great chart, and a lot of people are saying, Tyler, I think what you're describing is really hyperinflation, not a default in deflation. Well, that is one solution to the problem, and that's the solution that central banks around the world have been using since the year 2000. First under Greenspan, then under Bernanke, then under Yellen, and now under Powell. That is hyperinflating money out of nowhere to keep the game going. And as long as you've got room at the top to keep doing that before that debt reaches above all the wealth, it works. But it makes the problem worse the next time around, worse the next time around. I don't think there is a next time around. I think we've run out of those cards to play.
Yeah, I think we very dearly seem like we're at the top of what they can pull in terms of the monetary strings. I mean, we had the interest rates down at 0% for 8 years, which is unprecedented in thousands of years of recorded interest history, all the way back to the Greeks and Romans, etc.
And
So
30% of the world interest rates and currencies were negative over that period of time. Never had happened before in history. And a lot of them still are. It's only about 17 to 20% right now, but still negative interest rates, meaning you go to the bank, you put your money in, and you owe them money on your money.
I thought it was like that already. Just as soon as you go to put money in, they're charging you for things.
Yeah.
So I've always felt that we would start to see the explosions in inflation in countries other than the United States first, because of their difficulty to keep up with what would be what still seems to be the story of a strengthening dollar under the weakening stock market and the confusion about how markets and economies work in general. Do you still feel that the strength in the U.S. dollar is going to continue over the next year or two? And because my sentiments are starting to lean more and more towards that direction as well. The people just don't know what to do, so they're running back to probably the worst choice, which is fiat.
Yeah, that's a great question. I wish I could be definitive on it, but I've been wrong. I thought what we were going to be seeing right now is gold weakening and the dollar strengthening. And gold has been very persistent on this move up from 1100 to 1328, 1330. And the dollar has gone just for the last week or so into a period of remission where it's slightly gone down. And we've actually started buying a little gold. Just real quick numbers, gold went from $262 up to $1,900. And basically, we were in that trade the entire time, got out at about $1,750 as it dropped from $1,900 down to $1,100. And then it's been trying for the last 3 or 4 years to stabilize between $1,100 and $1,380. It's hit $1,380 on 3 or 4 different occasions. Can't seem to break through it, drops on back. So during the last 3 or 4 years, we've been in a little bit, out a little bit, in a little bit, but we've been out until just last week because gold prices were able to get above 1,315, and silver prices got above 15 and started approaching 16. And just technically, using some other things that I have, a system I call Consensio, it's just saying you got to start leaning in the direction of gold and silver up. Now, using Tone's work on sequential, we're on a 9 weekly on the sequential system, which is a sell signal on gold and over various time periods. But it appears to me that's only going to be a 1 to 4 period pullback before it heads higher. Tone disagrees. He thinks this is an important top on gold. I do not disagree with that. I'm just leaning a little bit the other way until I get more evidence. But your point about the dollar is the weakest of all currency, the strongest of all currencies where all of them are weak, including the dollar. Weak not relative to other currencies, which is the way we measure currencies. When we say the dollar is up, what we mean is it's up against a basket of other currencies. We don't mean it's up, in the ball game and we're going to win the ball game. It just means that relative to those that are growing their GDP at lower than we are, and it looks like we've got another 3.1%er in the quarter coming for GDP. Everybody else is messing around down at 1 or 1.5. Some are peeking their head up to 2. But that means that our economy is stronger than other economies. Therefore, we are able to keep our interest rates, and what the Fed's been doing is raising them. And when one central bank raises and everybody else is keeping theirs low, that makes the currency stronger and stronger. Now, the Federal Reserve is saying, well, okay, we overdid it. Trump was right, and some economists are right. We're going to back off. We probably won't be increasing anytime in 2019. And therefore, that weakens the dollar, strengthens the stock market. And now we're looking at all these things. Is the stock market going to break to the upside because of this action? Is gold going to break to the upside? Is the dollar going to break to the downside? We don't have answers today. All of these things are in the mix right now, and we're about to see some big things happen, and we've just got to wait to see as they do, so the technicals start telling us you need to move money here or there.
Brilliant. Yeah, that makes a lot of sense, because we're at a tipping point between so many different global economic factors. It's really one of those times. I mean, it's exciting. I like, one of the reasons why I like charting in general is because there's an invigorating aspect to seeing some of this stuff do it. Like, I know you guys are not necessarily a big fan of other of the blockchain spaces, but I remember Litecoin going from $2 to $300. That was just, that's just a pure excitement.
Absolutely.
It's a lot of fun. So I love keeping track of all this stuff. For anyone that has never seen Tyler's work before, you can find him on Twitter at Lucid Investments. You can also find him and Leah's work on YouTube at Hyperwave, and as well as their website, lucidinvestments.com. Is that correct?
Lucidinvestmentstrategies.com. Right.
No, investmentstrategies.com. I will leave all those links down below.
Thank you.
We covered a lot today, and I don't think we're anywhere near done, which is that exciting part that I wanted to bring up, is that a lot of this stuff is just starting still. So we've got a lot more fireworks to go in the future. I look forward to seeing which one of these potential options might spring up. For not one of the exciting ones, you wanted a sixth. You could probably throw a mini supernova in there where we just wipe everything, just wipe everything out.
Right.
That would be my sixth option, not the one I would like to choose, but definitely one of them at this point. Tyler, is there anything else you want to leave us out with today?
Only to say, I don't want this next move in Bitcoin to be a hype wave. I want it to turn into an S curve. I want
there's where it was.
This acceleration up to the top. It keeps going. And the thing that would cause it to turn this way into an S curve is adoption on a worldwide basis, where everyone agrees this thing actually works. There's a limited number and none of us can mess with that. No central bank, nobody at the centrality of what makes Bitcoin work. We stress in the article, there are no people in Bitcoin. There is no president. There is no CEO. There is no board of advisors. There's no board of trustees. There are no committees. There's no budget. There's nobody to protect it. There are no trademarks. None of those. It's the only crypto that falls into that category. Every other one has centralization to some form, and that's what we don't want to get this S curve. We want the world to have to adopt it because it works and nobody can monkey with it. And once it gets up to X level, whatever that is, to take care of the problem, it can go sideways for the next 600 generations.
Beautiful. That was a great point too, because I had asked about what you would like to see as in comparison with the hyperwave, and the S curve is the answer for that for anyone that had been asking. The last things I want to leave out with, obviously none of this is investment advice, strictly for information and educational purposes only. One of the reasons why I love doing this is one of the reasons why we have guests from PhD in physics to yourself, Tyler, is because we think the more content that we can aggregate, the better decision people have to make, the more critical options for thinking that there are. One of the other things that you brought up that I wanted to quickly touch back on too is that, yes, I had, like, for instance, I have a diversified portfolio. If anyone was wondering, I own property, gold, silver. I used to own stocks, but I won't touch those anymore. I prefer the crypto space, just strictly to the speculative enthusiasm that, as I was just mentioning. But it's really, really intelligent to, as you were saying, if this particular opportunity isn't the one that takes off, there are other options that could leave you hurt if you throw everything into Bitcoin. So make sure that you do not throw everything in. This is the time where learning your deep skill sets, your values, your patience, those are all assets that will never leave no matter where the markets are. So make sure you're always investing into those things, your loved ones, your family, your friends. It's extremely important. Those are things that money will never buy you time with. Again, I mean, Steve Jobs was noticeable for saying that. He's like, oh no, I did it wrong. I should have been spending more time with my family. So please make sure that you remember to do that. It's always one of the sentiments I like to leave everyone with. Tyler, thank you so much for your time today. Everyone smash that thumbs up, subscribe to Tyler and Leah's channel, and have yourselves a wonderful day.
Great. Thank you so much.
We'll see you again soon, Tyler. Ciao.
Great.